Hi, I am Vijay Kedia. Are you a new investor who is worried about the recent fall in the market and you're not sure what you should be doing in this scenario? Then probably this video is for you because you might have seen multiple videos, people trying to predict how much market can fall and then what are the reasons behind it, but still you are not getting the clarity that as an investor or as a long-term investor what you should be doing. So in this video I'm going to share two very strong insights with you, which will help you to answer some of your queries, concerns, and it will help you to stay in the market as a long-term investor. So the first thing I wanted to share with all of you is the month-wise return for last 20 years for Nifty 50, which is the index for the top 50 Indian companies. And if you see here, this is very powerful data. It gives you a complete picture that what is the month-wise return and year-wise return for the last 24 years. So if you see here in January 24, we had like almost zero return. In Feb, we had 1%. Then similar returns in April. In June, it started picking up. In June, we had 6.5% return, 3.9% return. And you'll also see that returns are not symmetrical. So you have sometimes a month with a very high return, some months with a negative return. So, for example, in 2022, you'll see Nifty 50 has fallen by 3.5%, almost 5% in June, right? And again, in July, it gained 8.7%. And if you see the year-wise return, so last year we had 19% return, but 2022 was not that good. So we had just 4% return. If you have long-term picture with you, it helps you to understand that you're not going to get linear return in the market. And if you are there in the market for the long term, you will see ups and downs where the markets will fall 5%, even 10%, and sometimes even more than that. So if you see in 2020, during COVID, market has fallen by 23% in March, though it gained a 15% in April, right? So we'll have those periods, and if we see Nifty index, how much it has fallen since its peak in 1 month. So peak was almost like 26,200. So and from here in last 1 month it has fallen by 7.76%, which is high. So it's not like it's more than 5%, but even 10% kind of fall is not uncommon. So if you see in 2019 we had 5.69% of fall. In 2016 Feb we had 7.6% of fall. So I'm not talking about the big falls here, which is like COVID or maybe the subprime crisis which happened in past and things like that. But even the normal scenario, there can be falls which is like 5 to 10%. It does not mean that you should change your strategy or you should change your allocation because of that. If we see last 25 years of journey for Nifty 50, in year 2000 we had this dot-com crisis, then we had subprime crisis, then we saw pandemic in 2020 where the markets has fallen sharply. But if you see, the sharp fall is always getting followed by the sharp recovery as well. If you stay invested for a long term, you will get your average return which is expected from Nifty 50. And my theory is that, say, if the world is not going to end, the markets are always going to bounce back, right? And if the world is going to end, then obviously you don't need that money anyway, right? So if you see last 25 years of returns, which is in Nifty 50 since 30th June 1999, which is like last 25 years, the annualized return is 14%. And 14% is like, with this rate, if you divide 72 by 14.2, it's almost like 5 years. So it means it's doubling your money every 5 years. So in 10 years it becomes 4 times, 15 years 8 times, and 20 years 16 times. That's the power of the compounding, which will keep multiplying your money, right? But you need to stay there for a very long term. And if you stop your SIP, if you sell your investment, so that you are not going to get the benefit of that compounding. The one thing which you can do in this market is, like, if you have some lump sum money to invest, slowly you can put that money into the market. Say the market has fallen by 5%, you can put some lump sum investment. If it falls by 10%, then also you can deploy some additional money. If you're not comfortable with putting additional money at this point, that's absolutely fine. But one thing you should definitely not do is stopping your SIP or redeeming your investment at this time, because if you stay invested at that time, then only you are going to see the next bull run. The second thing I wanted to share with all of you is about the price and earning ratios, where we divide share price by earning per share and we get price to earning ratio. So say if the share price is 100 and per share profit for that company is 5, you have price to earning ratio as 20. Similarly, for Nifty index, so there are 50 top companies which are part of that index. So there is a P ratio for that entire Nifty 50 index also. Index value is calculated by taking into account the share price of all 50 companies in whatever weighted average. And similarly, the price and earning ratio of all those 50 companies combined in the same weightage, you get the price and earning ratio of Nifty 50 index. And that is a very strong indicator of the current market valuation. So whether the market is very overvalued, undervalued, or at the comfortable level, that P ratio of Nifty can give you that idea. So next thing I'm going to share with you is the P ratio of Nifty 50, which is there currently, right? So if you see here, currently for Nifty 50, the P ratio is around 22. In September, it was around 24. See, last year it was around 20, 21. So if you see in 2021, P ratios were like crazy. It was like 40. That's very high valuation there. So now if you see this valuation indicator for Nifty PE, if P ratio is between 20 to 22, that is the kind of right valuation for Nifty, or at least if Nifty 50 P ratio is between 20 to 22, I'm comfortable, right? That is near the long term range. But if it goes beyond 22 to say 24, 25, it's a kind of a warning sign that market is getting slightly overheated, overvalued, and then there is a chance that it may fall. And then obviously, if it goes beyond 25, then it's slightly red, and above like 28, it's definitely a crazy valuation, right? So if you see here, currently we are around 22. Okay, so it was 24 in September. After fall, we are close to 22 now. So I would say we are closer to the Nifty long-term averages. So I don't expect that there will be a very strong fall from here, or even if that happens, we should see a recovery, because eventually markets need to come to near their long-term averages. So market cannot stay overvalued or undervalued for a very long period of time. So if you look at this chart, it gives you a comfort that currently Nifty 50 valuation is not very high, and there is some room for correction. It will correct, but even if it falls beyond say current valuation, it should recover. But thing is, it might take some time. So it might take days, weeks, months, or sometimes it takes even a year, right, or even more than that. But the thing is, as long as you have the right asset allocation and you have invested as per your risk profile. So if you are a very aggressive investor, maybe you have invested 70% of your portfolio in equity. If you are a conservative investor, you have invested 50% in equity, right? So if you're sticking to your risk profile, and if you have funds which you need in like 2 3 5 years outside equity, so obviously if the funds which you need in short term, you should not be investing that in equity, and ideally the funds which you need after 5 years, that should be there in equity. So if you have that kind of allocation, you don't need to worry, because in the long term, you will see the average growth which is expected from Nifty 50. Theoretically, whatever is growth rate for economy plus the inflation rate, you should get that return in the long term average. I'm long term, I'm talking about 10, 15, 20 years. So if the growth rate is 7%, so recently IMF also confirmed that your growth rate is going to be for India for this financial year will be 7%. And then say the inflation is 6%, then 7 plus 6 is 13%. So 13% you can expect as a return from equity. But that return is not going to be linear. So you will have ups and downs. But what you need to do is you need to stay invested, you need to maintain your allocation, continue your SIP, if possible try to do some lump sum, and then market will reward you for staying in the market. And if you are a short term investor, like who want to make quick money picking some smaller companies or penny stocks, doing future and options, obviously that is not something which I recommend to people who come into the market for the short term gains. Sometimes you might be lucky, sometimes you might not be that lucky. And in this kind of scenario, when the market falls, it becomes very difficult to continue if you're that kind of investor. But if you're a long term investor, you don't have anything to worry. And eventually, you will have the return what you're expecting in the long term. So these are the 2 points I wanted to share with you, which on the current market condition, which will help you to alleviate some of your concerns and give you some long-term clarity. Do share with your friends and family as well, who might have similar concern with the current market conditions. If you like this video, please hit the like button, subscribe if you have not done already, and do let me know in the comments if you have any questions about this video or you want me to make video on some topics, and I'll see you in the next video. Thank you.